Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate a consistent return year on year regardless of the size of your portfolio. So we're going to use AVGO, which is Broadcom. We're just going to use AVGO for the sake of this example. It's a nice liquid underlying. It has a healthy IV rank of 42.2. It's currently trading at about $170, just under $170 a share. And we're going to be using options as our vehicle to generate our returns. Specifically, we're going to be writing the options contracts, not buying the options contracts. So the first thing we want to do is, so we've got our underlying, right? We're not going to go into underlying selection, but we're going to actually look at strategies that you can deploy. So we go over to trade. Now, you can go for a weekly expiration if you wanted to, but we're going to go with a monthly expiration, and we're going to go a little bit further out. This will allow us to get more theta in the contract, more time in the contract, and will ultimately have a higher premium up front. So we're going to go with the October 18th, which is 33 days out. Anywhere between 30 and 60 days is fine. So now we have this options chain here. The market is currently closed, but it's fine. This is obviously just for example purposes. This orange bar shows you the expected move of AVGO over the next 33 days. Okay. So of course, we're going to be writing the options contracts. We want the underlying to expire far away from our contracts, from our strikes that we've sold, right? We want our contracts to expire worthless, and we want them to expire out of the money. So when it comes to choosing what strikes we're going to sell, we're going to obviously want to pick strikes outside of this orange bar. But how far do you want to go? Because the amount of premium you collect will drop off as well. I like to go anywhere between 16 and 20 deltas. Okay. So let's say for in this example, we go with a 16 delta. That works out to be the 192 strike. Okay. Then we go over to the put side, and we can find the 16 delta on the put side, and that's at the 148 strike. So now we have we're short one call at 192, and we're short one put at 148. Now what we have here is a range. Okay, so if we were to plot this on a chart, let's see what that would look like. So if you pull up the chart for AVGO, our put contract was at 148, which is about there, and our call contract is at 192, which is about there. So as we can see, we've created a range for ourselves, and in order for us to be right on this trade, we want the price to stay within this range. Okay, and so how do we know what the likelihood is that the price is going to stay within this range? Well, we can use delta. Delta is an indicator. However, the brokerage that we use, tastytrade, actually calculates the probability of profit for us, and it also calculates the probability of hitting 50% of max profit as well. So the probability of AVGO staying within this range by expiration is 75%. And the probability of this position reaching 50% of max profit at some point between now and the next 33 days is 89%, basically 90%. So as you can see here, before we've even got filled and entered the trade, the odds are already in our favor by quite a lot. Okay, typically we'd want to be wanting to get out at the 50% mark anyway, so we're looking at about a 90% probability of success here on this trade. Now, what do the numbers look like? So we know we've got somewhere between a 75 and 90% chance of success. How much premium do we collect? Well, we collect $3.70. That's per share. There are 100 shares in an options contract, so that's $370 we collect up front. And our broker is going to require just under $1,700 in buying power from us in order to put this position on. Now, you might be thinking, $1,700 is a lot of money, and you might not want to allocate that much to a single position in your portfolio. For example, if you've got a $5,000 portfolio, a $10,000 portfolio, you're not going to be wanting to allocate, $1,700 to one position. So what you can do is you can buy another contract a little bit further out. So we've sold the 192. Let's go to one strike down, the 194, and let's buy the 194. So we sell the 192, buy the 194. That's $2 wide, right? 194 minus 192 is $2 wide. You do the same thing on the put side, $2 wide. That will take us to 146, and we buy the 146. We sell the 148, $2 away. We buy the 146. Now, what that has done is that has massively reduced our buying power requirement down to $147. It does reduce the amount of premium we collect, but it also reduces the amount of buying power that's required. So the trade-off here is that you reduce your probability of profit, right? Because you collect less premium, therefore your break-even points are closer. So your probability of profit is lower. But in return for that, you have a much higher return on capital. Okay, so you're going to be collecting $53, and you're going to have $150 of risk. Okay, the return on capital there is considerably higher than the strangle that we were looking at before. Now, let's say if you wanted to tweak these numbers a little bit, you typically with an iron condor, you can go to the 20 delta, and more often than not, the numbers will work out better for an iron condor at the 20 delta mark. So if you move our short strike to the 19 on that side and 20 on the call side, still our long contracts are $2 away, 188, 190, 148, 150. Now we collect more premium up front, less buying power is required. And the reason why less buying power is required is our max loss is $2 because that's how wide our spread is. So the more premium we collect up front, no one can ever take this premium away from us once we collect it. So the more premium we collect up front, that offsets the $2. So let's just say, for example, if we collect 50 cents up front, $2 wide spread, well, now our max risk is going to be $150. It's $2 minus the 50 cents. What's left is 150. So the more premium we collect up front, the less buying power that's required. Let's go with the 25 delta, right? 184 and 186. 25 delta on this side, 154, 152. As we can see here, we collect even more premium up front and even less buying power is required. And let's just keep going further just to hammer the point home. Still $2 wide. We go up to a 40 delta on both sides. Still $2 wide on both sides. We collect $157 up front, and it's only going to require $43 of buying power. Obviously, our chance of profit goes down considerably, but you get the point that I'm trying to make here. You can play with this and you can manipulate the positions to fit your portfolio accordingly, right? If you want to learn more and see what positions we're actually placing and what we're doing to make money on a daily basis, links will be in the description. It will take you to this page. Everybody can get access to a free position sizing template, which is what we use, because it doesn't matter what you do and what positions you place. If your position sizing is wrong, you will eventually blow your account up. The way the position sizing template works is you enter in the size of your portfolio. Let's say if it's $15,000, you then enter the current VIX level. Let's say if it's at 14.2, everything below will then be automatically calculated. All you need to do at this point is use the information to build the backbone of your portfolio, use it as a guideline. It will tell you how much buying power to allocate to each undefined risk position, each defined risk position, and how much buying power to allocate to short premium in your portfolio overall. And you can get that for free. Just click the link in the bio in the description. Now, if you want access to all of our positions and see what we're doing, by all means, again, link in the description, click on EDS Premium, and it will take you to this page. Once you sign up for EDS Premium, you'll get access to all of our portfolios, all of our positions, so you can copy us. There is a full course as well, so no prior knowledge is required. You can learn and earn at the same time. You can speak with like-minded individuals. You can speak with myself directly inside the group. There is also a 100% money-back guarantee. So if you've studied our full course for 6 months, followed all of our trades, and haven't been profitable, then we'll work with you for free until you are, or you can request a full refund. So it's completely risk-free on your part. Right now, it's £1 a month. The price will increase. However, you're locked in at whatever price you get in at. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.